Hello, Dr. Tim Creel here. Talk about Chapter 2 and Module B in auditing. Go ahead and open up the presentation. Start the presentation. Okay, so this will be kind of similar to how we did Chapter 1, in that it's an overview of the chapter. It's a lot of high points, some of the main things in the chapter. You'll want to read every chapter because there's a lot of information in these chapters, a significant amount of information in there. So you'll want to read every chapter, but use this as kind of a guide as to probably the highlights and the most important aspects of the chapter and kind of a good summary of the chapter. So, chapter 2 starts with looking at professional standards, and it mentions some organizations like the AICPA, which I'm a member of. Um, in order to be a member of the AICPA, you can be a student member or you've got to be a CPA. Great organization. The PCAOB, Public Company Accounting Oversight Board. This was an organization created after the Sarbanes-Oxley Act started in 2002, and it was basically kind of a government organization, more kind of taking over the auditing industry and and setting more auditing standards. Basically, the auditing industry before Sarbanes-Oxley, the standards were set by the AICPA, and it was called Generally Accepted Auditing Standards, or GAS, as you can kind of see a couple of areas down. And so all publicly traded companies have to follow the auditing standards as set by the PCAOB and or have to be audited by those standards. They set the standards for the auditors. Now, private companies would still follow the AICPA rules, but publicly traded companies have to be audited according to the PCAOB rules. Where private companies, like I said, can still use the AICPA. Now, the stages of an audit our book talks about are to obtain the engagement. This would be where the audit firm would be deciding, do they want to take on this client or do they want to continue with the client? And basically this would happen every year. Typically the only reason that an auditor might not want to continue with the client a lot of times would be due to maybe the ethical aspects of the company they're auditing. If they don't feel like they can trust management or company leadership, that might be a good time for the auditor to step away. Engagement planning, if they decide to do the engagement, they would spend significant amount of time planning the audit. This would be when they would be doing some preliminary testing of the internal controls, and they would be looking at, okay, how many individuals are we going to need for this audit? How many hours is this audit going to take? How do we staff the audit? Do we staff it? What managers are going to take on the audit? What partner? The audit firm is doing a lot of planning in this stage, early stages. And then risk assessment, they would look at what areas of the company provide the greatest risk. And then they would kind of plan their audit accordingly, putting more emphasis in areas that have greater risk within the company. They would gather audit evidence. And then after the evidence is gathered, they would do their audit report or prepare the audit report where they give an opinion. Do the financial statements fall in with US GAAP? Are they in accordance with US GAAP, which would be the opinion of the audit? Now, some fundamental principles in this chapter, and also Appendix B goes into a lot of this, and basically some competence. So basically, competence and capabilities are fundamental principles, which means that the auditors need to have the proper level of education and experience. Doesn't mean that you couldn't bring in some new auditors, but you would want to make sure that you had some experienced staff to oversee them and to help them through the process. Independence and due care. Independence and basically here's kind of kind of the guideline you can follow for independence. And that is independence in financial relationships and managerial relationships, which means that the auditors cannot be invested in the client. The auditors cannot give, you know, do perform management functions for the client. Though those are prohibited if you want to maintain your independence. And think about it this way: if you're not independent, you can't do the audit. You got to be the independent auditor to do an audit under PCAOB standards. Do care would mean that you would follow a level of performance that would be achieved by reasonable auditors in similar circumstances, which means that if someone was to look at your performance, that it would be pretty standard that, okay, pretty much other auditors would do the same things that you're doing in similar circumstances. Again, we kind of go back to professional skepticism. We talked about this some in chapter 1. And professional skepticism would just mean that you basically have a skeptical attitude. You're always questioning and always verifying the answers that you're given to questions. You don't take their word for it. You corroborate that evidence. You corroborate what they're telling you. Professional judgment, what you're going to find is that a lot of auditing entails professional judgment. How much evidence do we gather? Is the evidence sufficient to support what management is saying? Is going to be a big part of what you do. So a lot goes into professional judgment. And again, it's a big responsibility of the auditor is being skeptical, practicing professional skepticism, and also performing professional judgment. Going to be a big part of what you're doing. What's material? Is the evidence sufficient? Do we have enough evidence? Things of that nature. Again, it's going to come down to professional judgment many times. Some more fundamental principles related to kind of performance of the audit. Reasonable assurance. A high level of assurance financials are free of material misstatement. And here's kind of something to think about. As an auditor, you don't give a 100% guarantee that the financial statements are free of material misstatement. There's no way you can. There's always the chance that something could be missed. But you give reasonable assurance, which is a high level of assurance that the financials that you've audited are free of material misstatement. Now, planning and supervision. Prepare an audit plan and properly supervise audit staff. Obtain a knowledge of the business and industry, which means that you are going to prepare an audit plan, which looks at, okay, who's going to be on the audit, who's going to oversee the audit, and typically this would be done by the partner. If the partner takes an audit, then they're going to be working with, okay, they're going to assign the manager, and then the manager and the partner typically are going to build their team to do this audit. And let's put it this way: if a company is maybe a new company, if it's in a new industry that the firm doesn't have that much experience in, then they might want to pick some more experienced auditors to do this. If they figure a client is a little riskier, then they might want to pick some more experienced auditors to do this audit. It would just be better. You wouldn't want to necessarily, in those cases, staff an audit with a lot of young or new auditors. Might not be the best choice in this case. So you prepare an audit plan. You properly supervise the audit staff. And again, you obtain a knowledge of the business and the industry that business is in. The AICPA has a good resource for the industry. Is the AICPA has industry guides that can be very helpful for learning about the industry of a company that you're auditing. Now, one of the things that you're going to do is there's some kind of timetables here. And that is when you're doing an audit, and this is basically based on the company you're auditing being on a calendar fiscal year. But notice that you would evaluate activity from January 1st to September 30th. This would be where you're doing your planning and interim work. If you've accepted an audit if you've accepted a company for the coming year, pretty much once you've accepted them, you would start planning that audit and you would start doing some interim work, which means you're looking at the quality of their system of internal controls. You're maybe even doing, and if their controls are good, if their internal controls are strong, you could start doing some of the audit interim basis, like through the end of September. And then when you come back at the first of the year, you would check basically September 30th through the end of the year. That would kind of be your normal year-end audit work. But if you've got the first half of the year done in as many areas as possible, you've saved yourself a lot of work during busy season, because there's a lot of companies that have a fiscal calendar year and audit firms are extremely busy, because remember that after year end, they have a certain number, companies have a certain number of days to get their audited 10K done, completed and audited and sent off to the SEC. So they're on a time crunch and it's a very busy time of the year. So the more that you can get done in interim periods through the year, the better off you are. Now, materiality. This is going to be a big thing. Whenever you're doing an audit, one of the things you're going to do in the planning stages is you're going to look at, okay, what is materiality for this audit? And what I mean by that is, think about it this way. If you're auditing Walmart, Walmart had over $500 billion in sales last year. And so if you're auditing Walmart, if you found a $10,000 error, that would not be material in terms of Walmart's overall financial picture. Now, you'd still let the company know about it, and the company would probably fix it, would correct the error. But that $10,000 would not in any way influence your opinion of the financial statements of Walmart because it's not material. So you're going to assess and kind of come up with a level of what's material for this company. And typically the smaller the company, the more material an amount would be. So typically they base it on sales or assets a lot of times. But we'll talk a little bit more about that later. Again, a lot of the things we're looking at in this chapter are kind of a little bit like chapter one, in that we're a lot of things we're being introduced to, but you're gonna see them later. See them again later. Materiality will be one you'll see later. Risk assessment, the quality of the company's system of internal controls. Um, let's kind of put it this way. If an auditor can rely on a company's system of internal controls, they can rely more on the internal information from the company. If they can't rely on internal controls, they're going to have to run a lot more substantive tests. They're going to have to get more information from outside or verified through outside sources, because they would have little ability to trust the internal sources within the company. Now, risk of material misstatement is a combination of inherent risk and control risk. Now, inherent risk is the risk that there's going to be material misstatements in the data. And control risk is the risk that the system of internal controls is not going to stop material misstatements. Couple of terms there to know. Now, as an auditor, you're going to perform substantive tests. And this is how you're going to gather evidence. Oh, whoa, let me take a step back there. You're going to gather evidence based on these substantive tests. And evidence must be reliable and relevant. Evidence also must be appropriate, which means of a high level of quality, and sufficient, which is quantity. Now, examples of evidence would be performing a bank reconciliation and looking at the bank statement coming from the bank. Gathering, verifying totals with outside companies. Again, that's a form of gathering evidence. Gathering information from inside the company, such as looking at invoices that were paid. So this is kind of what you're doing as an auditor. You're gathering evidence to support the totals that management is saying is on their financial statements, and looking at them in terms of management assertions that we talked about some in chapter one as well. Now, detection risk, another term here. the risk that the audit team's substantive procedures will fail to detect a material misstatement. Now, after gathering and evaluating evidence, the auditor writes a report where they express their opinion on the financial statements. It answers the question if the financial statements are prepared in accordance with GAAP. So the auditor's report has several paragraphs. It discusses what the auditors and company management were responsible for. Like the auditors were responsible for completing the audit in accordance with PCAOB standards, and management was responsible for the financial statements. They talk about the standards used in the audit. Of course, it would be the PCAOB, and a discussion of the opinion of the auditors. What opinion did they find with the financial statements? Do they support US GAAP? That's basically what they're saying in the audit report. Now, there would be four different types of opinions, or actually four different types of opinions, excuse me. The first one would be an unmodified opinion. This is what all companies want. An unmodified opinion just means that the financial statements follow US GAAP. Financial statements are good. They follow US GAAP, and the auditors have, that's what every company wants. About 99% of all audits end with an unmodified opinion because this is what companies want. A qualified opinion, you see the second one here, this would be an except for opinion, which means that everything on the financial statements follows GAAP except for. And if they did a qualified opinion, the auditors would insert a paragraph into their opinion stating what was a problem. What area was a problem that caused the qualified opinion. An adverse opinion is pretty rare. An adverse opinion would mean that the financial statements are in such bad shape that we do not feel that they follow US GAAP. That's rare. And if you ever want to lose your job as a CFO, get an adverse opinion and you'll lose your job in a hurry. But anyway, it's rare, but it just means that things are so bad that the auditors just the financial statements just don't follow GAAP. There's just many issues within them. And a disclaimer of opinion, this could happen based on, it's rare, but a disclaimer of opinion just means that the auditor cannot give an opinion on the financial statements. It would basically mean that either the auditor found out that they were not independent and they cannot give an opinion on the financial statements because they're not independent, or it could mean that maybe there was a fire and the company's inventory was destroyed and there's no verification of it, or a hurricane hit one of the company's warehouses and destroyed it and there's no verification for what was there. It just means that maybe if the auditor can't verify information, they can't say that the financial statements follow GAAP because they can't gather the evidence they need to support the financial statements and the numbers provided by the company. So a disclaimer of opinion could be due to the auditor, or it could be due to the company, or just maybe circumstance, weather, natural disaster, something of that nature. Now, evaluating the quality of public accounting firms. Every public accounting firm has a system of quality control, which they kind of measure, and they would have they typically have a partner in charge, and then they'll have a partner that'll kind of overlook the audit. Another outside partner will kind of look over the audit before it's finalized, just to make sure that everything was done that needed to be done. That's kind of an example of a system of quality control. Leadership responsibilities, the tone at the top. Think about it this way. Within any company, the tone at the top really sets the tone throughout the entire company. If you look at companies that had issues like Enron, the leadership at the top had little or no ethical basis to what they did at all. And that was the tone that went through the entire company. So when it comes to leadership, the tone at the top is a very important element of leadership within a company. Relevant ethical requirements. are very important, meeting certain ethical standards or going through ethical training. Most companies require their employees to go through some type of ethical training on an annual basis, and many accounting firms do as well. Acceptance and continuation of client relationships and special engagements. Again, a company would look at how do we evaluate what criteria do we use to evaluate whether we're going to keep a client from year to year or accept a new client. They would have to have standards as far as human resources with hiring and making sure that they're hiring competent and ethical employees to join the firm. Engagement performance, again, judging and examining, having higher levels within the firm evaluate performance within the firm. Monitoring performance of audits within the firm, again by higher levels, like like another partner overseeing or looking in on the audit before it's completed. And one thing too, if you are a public accounting firm and you audit publicly traded companies, you have to register with the PCAOB, and you have to be audited by the PCAOB. If you're a large firm like one of the big four, every year, and if you're a smaller firm, every 3 years. And basically what the PCAOB auditors will do is they'll come in and they'll want to see certain audits that you've performed, and they'll look at your work that you've collected and your evidence backing up your support of your opinion, and they'll want to make sure that did you gather sufficient and quality evidence to support your opinion. That would be part of their inspection of the activities of a firm. And again, for larger firms every year, for smaller firms every 3 years. And I would say this too, this is another reason, and we'll talk about this a little bit more later, is that auditors need to be very concise and accurate and make sure that they have all of their backup available to support their opinion, because it could be audited by the PCAOB. Now, let's jump over to Module 3. And Module 3 jumps into ethics. And of course, it's grown in importance since Enron. All publicly traded companies must have an ethics policy. Many have required ethics trainings. They have like 1-800 hotlines where you can report, any activity within the company that you would consider to be illegal or unethical. And again, as a CPA, you must complete 2 hours of Tennessee specific ethics as part of your annual continuing professional education. So remember that you've got to have 80 hours every 2 years, and you got to have 2 hours of that must be Tennessee specific ethics, CPE. Independence, Module B. Independence in attitude and appearance, and that's what we mentioned as far as independence back in chapter 1. And here again, this is kind of what this whole thing is based off of. Avoid financial connections and avoid managerial connections. Covered members cannot have any financial interest in clients that would affect their judgment. And kind of a definition of a covered member: firm professionals closely connected to the audit engagements, firm's owners who are located in the office where the lead engagement partner practices. So if you work on the audit, you'd be considered a covered member. Also, close and immediate family members of covered members would also be considered covered members. So your spouse, your kids, and even indirectly, in some cases, your parents could be considered. And so here's the two main things to get out of this. Don't have financial connection. You can't have financial connections and be independent, and you can't make managerial decisions for a client and still be independent. Those are the two things to keep in mind. And it falls to all those on the audit team. And other partners and leadership of the firm that are located in the office where the lead engagement partner practices, and their immediate family members of all those mentioned. Now, what I mean by what I mean by financial connections is I could, if I was an auditor and I was on the audit team auditing Apple, I could not own one share of stock of Apple. And I could not have a indirect investment in them either. My 401k plan cannot be, you know, cannot invest in Apple either. If I'm on the audit team, my kids, if they live in the house with me, can't invest in Apple. My wife can't invest in Apple. My parents can't have a significant investment in Apple. Like like my parents couldn't own like 10% of Apple and I'm auditing them. That would be considered a significant investment in it. If my parents owned 10 shares of Apple and I didn't know it, wouldn't be significant. But my household cannot directly or indirectly invest in Apple if I'm doing their audit. And so Module B looks at this pretty thoroughly, and there's a section in Module B you want to read and read it closely because it really goes over the rules of independence. And this is something good to know, and it's something that you're going to see on the CPA exam. In summary, the audit engagement team, the chain of command in the firm, and covered individuals in the firm, and close and immediate family members cannot have financial connections and cannot have managerial connections with the firm. Now, another thing I would mention there is you got to watch close family members' connections as well. Like, what if I'm auditing Apple and I'm on the audit team and my wife is the CFO of Apple? Then there's too close a connection there, and I cannot be on the audit team. I would not be considered independent. Now, if I'm auditing Apple and I'm on the team and my wife manages the Apple store at the Green Hills Mall in Nashville, that would not be considered, that would not basically stop my independence because the spouse would need to be in a condition or a position of great influence within the company. She's the CFO, she's the controller, something of that nature. If she doesn't work in accounting, and has just a regular position within the company or works in a store, that would not make me not independent. Now, again, we'd have to watch that she doesn't own any stock, but that's just, again, kind of an example to follow there, or another kind of aspect of this independence is, does your spouse have a pretty significant position, or does your dad? What if your father was vice president of Apple? Then that would probably cause you not to be independent. What audit firms do is every couple of times a year, they'll ask you, have you invested in any of the clients? And actually accounting firms, their portfolios, really really look at, okay, we can't invest in the clients. The accounting firms are communicating with their investment firms, and if they gain a new client, then they need to move their investments, their employees' investments out of the company that they're going to be the new client with. So there's a lot that goes into that firms do. And if you work for a firm, they're going to ask you a lot of questions about your personal investments and your spouses and your kids and family members and things of that nature, what their investments are as well. So be prepared. Many non we talked about this some in chapter 1. Many non-audit services are prohibited for audit clients by SOX. So basically, if my firm does the auditing for a company, they cannot do their bookkeeping services, their information systems advisory services, appraisal or evaluation services, actuarial services, internal audit services, management services, human resource services, broker-dealer services, legal services, expert services, and many aspects of tax services cannot be done as well. And then AICPA rules of conduct. These would be things that all CPAs would have to follow. Integrity and objectivity, which means that you would hold high integrity in what you do, and objectivity would mean that you would take an unbiased approach to your work. The general standards rule is that you would be professionally competent to do your job. You practice due professional care, planning and supervision with your work, and gather sufficient and relevant data. An auditor cannot disclose confidential client information. Um, here's something to kind of think about it. Here's something to kind of think about. You're not to disclose information about a client, but the CPA client relationship is different from that of a lawyer client relationship, which means that a court could come to you and say, we need this information on your client, and you would have to give it. If there's a court order, you've got to follow that, a subpoena. um, you would have to give that information and possibly appear in court. You'd have to. Um, but outside of a court order, you don't give away any client secrets or client information. A member in public practice shall not charge contingent fees. What this would be is like, what if I said that if I get you an unmodified opinion, you'll pay me this much? If I can get you this much of a, if I can give you this, this type of an opinion on your system of internal controls, I get this much. You don't want fees based on certain opinions or contingencies. So that's basically what that says. Commissions and referral fees, you cannot do those unless they're disclosed to the client, which would mean that if I told you you needed to get this system, to buy this system for your information systems, I would have to disclose that I get a commission from this company if you do this. I would have to disclose that to you as the client. Typically, it's just not good for CPAs and audit firms to do things like this, to sell other products and get commissions from your clients, or referral fees for certain services that you're referring. Not necessarily the best thing to do. I think they should be avoided. You could do that, but you would have to disclose that to your client that you could go with this one, but I get a commission from them. I have to disclose that to you. I think they're better avoided. Discreditable acts rule. This would mean if there are certain discreditable acts, such as if you were to retain client records for non-payment, that's a discreditable act. If you're a CPA and you don't file your own tax return for like the last 3 years, that would be a discreditable act. You could lose your CPA license over that as well. Advertising and other forms of solicitation just means that you couldn't advertise like, I guarantee you the biggest refund on your tax return. As a CPA, you could not advertise in that manner. Forms of organization and name rule. What this kind of means is that you can't name a firm all as CPAs and members of the AICPA unless all partners are, everyone in the name, all the named partners are CPAs and members of the AICPA. So you just have to name it appropriately based on professional designations such as CPA, or if they're members of the AICPA. What you're going to be auditing, and I kind of put a link here to the Edgar page. Edgar page is a great place to look at 10K reports. And also 10Q, which is quarterly. A 10K is an annual report, which is audited. 10Q is a quarterly report, which is reviewed. And an 8K is simply a report of significant happenings. And I put a listing here to the main page for Edgar. This is the SEC site, and you can look up any company's 10K report there, or 10Q, or the 8K reports that they've issued. Remember that when a company completes their 10K or any financial information and sends it to the SEC, it becomes public knowledge. And also, I've got some links here to sustainability reports from Walmart and Apple. Again, this is a very growing area for auditors, and auditors are doing a lot more auditing um, of basically ESG reports, environmental, social, and governance reports. And so I've got links to a couple of them here. Many times they're over 100 pages in length, and it's companies basically sharing a lot of their data and information about what they're doing in terms of ESG. And that is all for chapter 2 and appendix B. Thank you and have a great day. Bye-bye.